Hi, in today's video I'm going to explain the Elliot Wave Theory, and I'm also going to show you how you can use it in your trading. So Ralph Elliot was a theorist and a professional accountant. In the 1930s, he identified the fundamental social concept and developed analytical methods. So he suggested that market prices follow precise patterns, which are now known as Elliot waves, or just simply as waves. So what is the Elliot Wave Theory? Well, Elliot proposed that financial price movements were the outcome of investors' primary psychology. He discovered that changes in public opinion always manifested themselves in the same periodic waves in financial markets. So the Elliot and Dow theories are similar in that they both acknowledge that stock values move in waves. Elliot, on the other hand, was able to dissect and study the markets in far greater depth. Elliot began to investigate how these recurring patterns could be used to forecast the future of market movement. So we know in the financial markets that what goes up must come down, because a price movement up or down is always followed by a price movement in the opposite direction. Price is split into two categories: the trends and the corrections. So prices move along a trend while corrections go in the other direction. So 5 waves travel in the main trend direction in an uptrend, followed by 3 waves in a downtrend, and then in the corrections direction, totaling a 5 to 3 move. So the next higher wave move is divided into 2 subdivisions. By this 5 to 3 motion, the impulse is formed by waves 1, 2, 3, 4 and 5, while waves 2 and 4 are corrections. So let me talk about these waves. Okay, so the first wave is the beginning. It is an upward price change triggered by a large infusion with one or another asset. It is difficult to predict because the sharks determine the trend, the rest of the traders just support it. Okay, and then the second wave is a correction. It is formed as a result of partial closing of buyers' positions and a desperate attempt by the sellers to add the previous position and hedge the loss. Then the third wave is the strongest. Sellers stop selling as more buyers come into the market, so a steady upward movement is forming. Okay, and the fourth wave is a correction. So large players fix their profits, realizing that the current movement is already losing its relevance. And then the last one, which is the fifth wave, is dangerous. Well, because it is formed at the expense of late buyers. It is misleading because the trend reverses sharply. So a similar situation occurs with the downtrend movement. However, the downtrend has 3 waves. And now the most important part, which is how do you use the Elliot Wave Theory in your trading. So it goes without saying that you should enter a trade at the start of the third wave formation for successful trading. You must first analyze the wave structure and forecast the end of the second wave in order to predict its emergence. And you will need the following to configure on your trading charts depending on which trading platform you are using. So the first thing you have to put on your trading chart are 2 indicators, which are SMA and moving average. Okay, second, you have to put 2 moving averages having the parameters of 14 and 21. Then you should also use the Japanese candlestick chart type, and the time frame to use 15 minutes time frame or 30 minutes time frame. And lastly, keep an eye out for the impulse movement, which will indicate the start of the first wave. In this situation, the 14 period moving average should cross the 21 period moving average after the flat. So the intersection direction suggests a trend. Okay, so you should also build a support line if the trend is up and wait for it to break, of which that will be the beginning of the formation of the second wave. So everything is a total opposite in a downtrend. Also build a resistance line for an uptrend or a support line for a downtrend with a second wave for a downtrend. So when a breakout occurs, it indicates the start of the third wave. Then you can buy in the trend's direction. And the most important part you should watch out for is that the moving averages should not touch or connect on the chart, otherwise the signal will be false and the market does not have a consistent trend. Okay, so setting the expiration time to 3 candles is suggested. So to conclude, Elliot Wave practitioners emphasize that just because a market is fractal does not mean that it's easy to predict. Although scientists acknowledge a tree as a fractal, this does not indicate that the path of each of its branches can be predicted. In terms of practical application, the Elliot Wave principle, like all other analysis methodologies, has its supporters and opponents. Okay, so one of the major flaws is that practitioners may always blame their chart reading rather than the flaws in the theory. If that fails, there's always the open-ended interpretation of how long it takes for a wave to complete. So traders who adhere to Elliot Wave theory, on the other hand, are ardent supporters of the theory. So this is it about today's video. If you learned something from it, give it a like. For more videos like this, go on and subscribe, and don't forget to check out the links in the description. Bye for now.